Good evening, one and all, and welcome back to Rainbow Investing, where we examine a spectrum of ideas to increase your long-term wealth. Now, today I wanted to talk about active investing and different styles that people go about this. So this might be more for your active investors out there, people who are wanting to, or who have already started active investing. But the styles I'm going to talk about today are normally things that you hear when you hear people who buy and sell shares categorize themselves as. So it's very broad. It's sort of two camps of active investors that we're going to discuss here. So it's going to be growth and value. So we're going to look at both and see what the different styles are and maybe what's right for you. Alright, so let's get right into it. So the first style I want to talk about is growth investing. Now, this is an interesting style of investing, and if you do it well, you can make a lot of money. Let me just explain what it is. Basically, growth investing is finding a company that you think is going to grow very rapidly and basically riding it into the sky. And hopefully getting off it before it crashes, because as we all know, all stocks eventually have corrections of some kind. So if I was a growth investor, what I'd be looking for is a company that I think is going to grow very quickly over the next either 1, 3, 5, 10 years even. And I'd be looking at getting in early before other people do and maybe riding that growth all the way up. Because how investing works is often companies who show promising signs of large growth will often go unnoticed by big money. Now this means the big institutional investing firms that have a lot of money behind them, because once they start piling into a stock, it pushes the price up very, very quickly. So growth investors often try and get in front of those people and sort of ride it up, ride it into the sky. So growth investors often want to be the first one in and the last one out of the stock. So what that means is they want to get in before everyone else, and they want to get out before the price starts to tip. So think about it as riding a wave. You ride it up to the peak and then hopefully you pull out before it crashes. Now the thing you have to remember about growth investing is it's often very industry specific. So the industry that comes to mind is tech stocks. Now you can see this quite a lot in the US, but also in Australia with stocks like Afterpay. There's been a lot of growth investors going after Afterpay, Appen, Altium, Xero, those kind of stocks. So they're all stocks that have experienced huge growth, particularly this year, and you'll see a lot of growth investors piling in and piling out. That's what makes the stocks so volatile. But you've seen this in America quite a lot over the last, particularly 5 years, with the FANG stocks. So that's Facebook, Amazon, Apple, Netflix, and Google. These are the mecca of growth investors, and you'll see a lot of them piling in and piling out. And you'll hear most people who are growth investors really talking about those kind of stocks. Now, the other industry I think that is really exposed to growth stocks is the marijuana industry. Now, this industry has been big news in the United States over the last couple of months because they've had what we can only really call a bubble in marijuana stocks. If companies had anything to do with marijuana, their price has just gone ballistic this year. Particularly, I think it was about in September, it was really going nuts. It really reminded me of the whole Bitcoin cryptocurrency thing. But basically how it works is a lot of states in America have started to legalize marijuana, and people have sort of cottoned onto this and thought, hey, this is going to be a huge growth area into the future, because I think there's only less than 10 states at the moment, it might be about 10, I'll have to double check, that allow for marijuana, but most people think this is going to grow a lot more into the future. So of course, companies that are selling marijuana, they are starting to look really, really attractive because of this reason. People are trying to get on them before they shoot upwards. So thinking about those things, you can really understand what motivates growth investors. So the last thing I want to say about growth investing is it's quite risky. You obviously are trying to time the market a lot. You're trying to get in front of people. And if you think you're getting in front of a stock that other people are going to get in front of in the future, there's quite a large possibility that that won't happen, that maybe the stock fizzles out, because these companies often are quite new, they're quite exciting, they will often not be able to compete in the long term when someone else comes along and does what they do better. So that's the big risk when it comes to growth investing. Alright, so let's talk about value investing, and this is the style that I personally try and follow a bit more. So the first thing you've got to know about value investing is this is the style that Warren Buffett and most successful investors adopt. So you got Phil Town, Benjamin Graham, Charlie Munger, all those guys really follow value investing principles. So let's go through it a bit more. So value investing is really about finding companies that you believe are underpriced by the market. So that means that through your own research, you've discovered that the market might not be pricing in its correct value. So if you do some sums and work out a company is worth $100 a share, and it's trading at $50 a share, value investors start becoming very interested. It's literally the definition of buy low, sell high. Now, you can see it's quite different for growth investors because you're actually not trying to follow the crowd or even get in front of the crowd. You're trying to find what the crowd isn't looking at. And this is basically how Warren Buffett has made most of his money. He is an absolute genius at actually looking at the company's numbers, working out what he thinks it's worth, and then looking at the market and looking at what the market's pricing its value at, and then acting accordingly. He always says that price and value are not the same thing. He says price is what you pay and value is what you get. So he obviously likes to get more value with less price. So for example, if you saw my video about stocks I'm watching in December, I talked about Apple. Apple has gone from a high of $230 and I think it's trading below $185 now. Now, value investors, that would automatically pique their interest and they'd be looking at very hard at Apple to see whether the market is perhaps undervaluing Apple at this very time. Because you've got to remember about stock market investing is the market is quite emotional and it will overreact to a lot of different things. And that's what value investors wait for, overreaction. So the last thing I'll say about value investing is it can be more predictable. If you have a look at a company and work out its value using your own metrics, and then you look at the stock price and realize that the company you're looking at is really undervalued. So you think it's worth $100 and the market's charging you $50 for it. That's when value investors get really interested. Now, it's usually the harder path to go down because you need to do a lot of research. You're thinking about things that the market is telling you not to. So when the market's pricing a company low, there'll be a lot of people saying, this company's rubbish, don't go anywhere near it, there's a reason why it's low. And you've got to think, no, you guys are all idiots. I know that this company is worth more than this, so I'm going to buy $10 for $5. That's really what it's all about. It's saying, I'm going to get $10 of value for $5 of price. And that's how people get rich, using value investing. All right, guys, so there you have it. 2 active investing styles. Maybe think about which one you really relate to more if you're thinking about getting into active investing. Now, both are risky, and I highly recommend that you do your own research, whichever method you pick, because both of these things require a lot of dedication, a lot of research, and if you think maybe that's not for you, then maybe give passive investing a go. Got a couple of videos about passive investing, so check them out if you think that's more for you. But that's what I've got to say, guys. It's quite exciting looking at this stuff. I had a lot of fun making this video, so if you liked it, hit the like button, hit the subscribe button if you're new here. We talk personal finance and investing. And as always, I'll be back with more videos soon. But for now, good night.